IFRS 1 First time adoption of International Financial Reporting Standards. What is the objective of IFRS 1? IFRS 1 First time adoption of International Financial Reporting Standards sets out the procedures that an entity must follow when it adopts IFRS for the first time as the basis for preparing its general purpose financial statements. Derecognition of some previous GAAP assets and liabilities. Number 1. Eliminate previous GAAP assets and liabilities from the opening statement of financial position if they don't meet IFRS recognition criteria. Number 2. For example, IAS 38 does not permit recognition of expenditure on research, startup costs, training, advertising, and certain other items as intangible assets. Recognition of some assets and liabilities not recognized under previous GAAP. Point number 1. Recognize all assets and liabilities required by IFRS, even if not recognized under previous GAAP. Example: include derivative financial assets and liabilities, employee benefit obligations, and provisions. Reclassification. Reclassify previous GAAP items into appropriate IFRS classifications. For instance, certain dividend liabilities may need to be reclassified. Treasury stock recognized as an asset may be reclassified as a component of equity under IFRS. Next, measurement. Apply effective IFRS to measure recognized assets and liabilities. Recognizing adjustments. Recognize adjustments needed to transition from previous GAAP to IFRS directly in retained earnings or another equity category. Estimates. Use inputs and assumptions used in previous GAAP estimates at the date of transition to IFRS, except to correct errors. Changes to disclosures. Number 1. New disclosure areas may be added under IFRS and existing ones may be broadened. Number 2. Include explanations of how the transition affected financial position, performance, and cash flows. Disclosure of selected financial data. Number 1. Optional disclosure of selected financial information from periods before the opening IFRS statement is not required to conform to IFRS. Number 2. If disclosed based on previous GAAP, it must be labeled as non-compliant and include a narrative explanation of adjustments. Next, disclosures in the financial statements. 1. Disclose the impact of the transition on equity, comprehensive income, financial position, and cash flows. 2. Reconcile equity and total comprehensive income from previous GAAP to IFRS. 3. Explain material adjustments made during the transition. Number 4. Disclose any errors discovered during the transition. 5. Disclose impairment losses and specific recognition exemptions if used. Next, disclosures in interim financial reports. Previous one was in financial statements. Now, in our interim financial reports, number 1, certain disclosures are required in interim financial statements before the annual statements, only if they purport to comply with IAS 34. These include reconciliations between IFRS and previous GAAP. Exemptions to retrospective application of other IFRSs. Number 1. Exemptions to retrospective application apply to IAS 39, hedge accounting, IAS 27, full cost oil and gas assets, and determining lease arrangements. Number 2, these exemptions simplify transaction for first time adopters. Optional exemptions from basic measurement principle. 1. Various optional exemptions are available for different categories of assets, liabilities, and financial instruments. 2. These exemptions provide flexibility in adopting IFRS. Next, business combinations that occurred before opening statement date. 1. Entities may choose to retain their original previous GAAP accounting for certain business combinations. 2. Goodwill and asset carrying amounts may not need to be restated. Next, deemed cost. 1. Assets carried at cost may be measured at fair value at the date of transition to IFRS. 2. Fair value becomes the deemed cost under the IFRS cost model. IAS 19 Employee Benefits. Actuarial gains and losses. Entities may choose to recognize all cumulative actuarial gains and losses for defined benefit plans at the opening IFRS statement of financial position date. IAS 21 Accumulated Translation Reserves. 1. Entities may elect to recognize all translation adjustments in accumulated profits or losses at the opening IFRS statement date. Second, this resets the translation reserve included in equity. Last, IAS 27 Investments in separate financial statements. 1. Measurement options are available for subsidiaries, associates, and joint ventures in separate financial statements. 2. These options depend on the adoption dates of the parent and investee. This video attempts to summarize entire IFRS 1. Subscribe to Mango Accounting on YouTube to keep learning.